Okay, good afternoon.
Good afternoon, sir.
Yeah. Okay, so we use our class time to introduce um, the chapter 5 and chapter 6 and chapter 7 in this from this textbook, business and analysis and evaluation. Okay, so we quickly go through the introducing of the some the financial implications, okay, from the chapter the 5. So the chapter 5 providing two concepts. So first one is the introducing the primary the tool of the ratio analysis. What is the analysis of ratio? The ratio analysis is to assess how various line items in financial statements related to each other and to measure relative performance. For example, you can take one from balance sheets to um, divide it by the income statement, something like that. So, for example, so you can take the equity from the balance sheet, and also you can take the in, profit or loss from the income statement. So to form the ROE, okay, return on the equity. Okay, so this kind of the ratio, which is called ratio analysis. Okay, and the next one, that is the cash flow analysis. Is to evaluate liquidity and the management of operating, investing, and the financing activities as they relate to the cash flow. Okay, so here, so we got to know the determinants of firm value. Okay. I'm not sure. So you have memories from some videos. They introduce how we can determine the firm value. Okay. So here, okay, you can recall that from the slide. So the first is profitability and the growth. Okay, so profitability from the operating activity and growth from your investing activity. Okay, so this kind of the driving factor can drive the firm value. Okay, so and the managers can employ for levers to achieve growth and the profit targets. For levers about the operating management, investing management, and financing strategy, and dividend policy. Okay, so ratio analysis seems to evaluate the firm's effectiveness in these areas. Okay, so the figure point 5.1, introducing the drivers of private firms, the productivity, and the growth. Okay, so as you see, there are two markets, product markets and the financial markets, and supported by operating management and investment management. Okay, so and the financial markets are supported by financing decisions and the dividend policy. Okay, so how we go well on the operating management and the investment management. So we need to managing revenue and expenses and working capitals and fixed assets. How we go well on financing decisions and dividend policies. So we can use the funds from the return earnings and we can control the debt ratios and to well manage our liability and the liquidity. And about this payout by the dividends, we know some companies characteristics they have the payout policy. So the payout from the earnings, the payout from the net borrowings. Okay, so about is the payout the policy. Sometimes we have a balance out between what we have and what we get from the financial markets. Okay, so here ratio analysis, evaluating ratios require comparison against some benchmark. Okay, some benchmark include the ratios over time from prior periods, ratios of the other firms in the industry. Some absolute benchmark effective the ratio analysis must attend to relate the underlying business factors to the financial numbers. The text illustrates the ratio analysis by applying it to European fashion retailers, HMM index, and other industry peers. Okay, so the table 5.1 shows that HMM the performance, the ROE in the different year. So 2014, 2013, Intertest also at 2014, 2013, and other peers we just showed 2014. It is the ROE. Okay, so the definition by ROE, that is the profit or loss over the shareholders' equity. Okay, we know that ROE is a comprehensive measure and a good starting point to systematically analyze firm performance. Okay, so we can decompose the ROE into the two items. First one is ROA, another one is the equity multiplier. So ROA, the definition, profit or loss over the total assets. The equity multiplier, that is the total assets over the equity. Okay, so here table 5.2, there is the traditional decomposition of ROE. Okay, here so the table 5.1 at HMM at 2014 of ROE 41.3. So here we decompose it by the ROA and the equity multiplier. So we have the ROA 14.7 and the equity multiplier 2.81. So the 41.3 that is multiply the 14 point by the 2.81. Okay, you get. Okay, so the same way at 2013 year. Okay, so you also can decompose it to get that. Okay, so here as ROA 14.6 and equity multiplier. Okay, so 2.65, and the other peers here 3.91 is a competition opponent. So and at a different year 1.85 and 1.84. Okay, so compare this to its a competition opponent or other peers. Obviously you can see that the equity multiplier of the HMM in different year So a little larger than a little bit larger than the interest rate, but is less than the other peers. Okay, so you can infer this ROE of the HMN in different year better than the interest. One possible reason is from the equity multiplier. Okay. The traditional have some has some limitations imposed by composition of the denominator and the numerator. So alternative approach computes ROE as automatically being equal to return on the business assets plus the spreads times the financial average. Okay, so ROE here NOPAT NOPAT. So the numerator NOPAT and NOT is the net operating after tax the profit. Okay, so P is profit, O is operating, net. Okay, I is investment, P is the profit, S after, T is the tax. Okay, after tax the net investment profit. Okay, so your total net profit from the operating and the investment. Okay, so because we want to get the equity value, so the NOPAT and the NAPAT, that is the total benefits. Okay, so we need to deduct the benefits of the equity. So we deduct the interest expenses. We know the interest expenses we have to give some payment to the bondholders, right? So every period. Okay, so the interest expenses, that is what we have to give some payments to bondholders. Okay, so here NOPAT plus NOPAT. Here we insert. Okay, we plug in the business assets. Okay, in denominator, and also we plug in the business assets in the numerator. Okay, so and we decompose it into the items. Okay, first item, that is the NOPAT plus NAPAT over the business assets, and the second item, that is the business assets over equity. So this one we know that is the equity multi layer, right? Okay, so this one also in plugging the debt in the denominator additionally, and also we plug in the debt, okay, in the denominator, and we separate, okay, into the two items. Okay, first item here and second item here. Okay, and we know the business assets can decompose it to the equity value plus debt value. So here, business assets over equity can decompose it the 1 plus debt over the equity. Okay, and we combine this item time this and this. Okay, so here we have the NOPAT plus the NOPAT over business assets here, which is called return on the business assets, and the return on the business assets, this one minus this one of effective interest rate after tax times the financial average. So here, which is called spread. Okay, spread. Okay, spread. Yeah, and here you can here ROBA can decompose it the NOPAT and over this business assets plus NOPAT over business assets. Okay, so right now, this one I insert the operating assets here. Also insert operating assets. So this one that is your firm the return on the operating assets, and this one is your weight. Okay, and this one that is your investment return on the investment assets, and this one and this is your and the other weight. Okay, that's your weighted. Okay, so this one and this one. Okay, yeah. So can know from table 5.3 the various definitions of counting items used in ratio analysis. So here introducing the definition of interest expenses after tax. Okay, here interest expenses times the 1 plus tax rate. NIPAT, there is the investment income plus interest income times the 1 minus tax rate. And the profits or loss, the net investment profits after tax plus the interest expenses after tax. Okay. So balance sheet items, operating working capital. So here, so current assets minus the excess cash and the cash equivalent. And here, so minus the current the liabilities minus the current debt and the current portion of the non-current debt. Okay, there is your working capital. Okay, and net non-current operating assets. Okay, here and the investment assets, minority equity investment and plus the other non-operating investment and plus assets cash and the cash equivalent. Net operating assets, operating working capital plus net non-current operating assets. Net operating assets plus the investment assets. The debt, okay, so the total interest bearing the non-current liability plus current debt and the current portion of the non-current debt. A capital debt plus the group the equity. Okay, so here distinguish operating investment and financing components in our decomposition. So here, so remember that's the from the table 5.1 at HMN is ROE at the 2014 year, so 41.3, right? Okay, so here we buy the formula equation to decompose it, and let we have the many components. Okay, so here, so we have a new components. There is a spread. Okay, 16.8, and the financial leverage there is 1.36, and the business ROBA, okay, we have 18.3, and net operating, okay, so here 19.2 times this plus the investment, the return, okay, so time this, multiply it by the 0.94 plus the 4 time by the 0.06, we have an 18.3. Okay, so you can check. Okay, this is a new way to decompose it, your ROE. Okay, so here the traditional alternative here, so asset turnover, this one, okay, ROA, this one, okay, so this one, okay. The following the ratios also helpful. Also, the growth, the margin, EBITDA margin, and operating margin. So gross gross profit margin here, that is the revenue minus cost of sales over the revenue. On OPAT, there is the net operating profit after tax. Okay, so EBITDA, earnings before interest, taxes, depreciation, and amortization. This the number you can get from the income statement. Okay. Okay, so here let's before test here 7.7. Okay, 7.7. So 100 minus 82.3 equal 70.7. So you have the profit loss. You have a profit loss, and we have this add back the interest income minus interest expenses, and to pay government by tax. Okay, so this. Okay, so your profit or lose the 13.2. Okay, so let's operating expenses that items as a percentage of revenue. Okay, so the table demonstrates this: the personnel expenses, cost of material, and the depreciation, amortization, and the other operating income expenses. Okay, this. And by this is by nature. Okay, by nature definition to list the uh, all of expenses. Okay, and if you adopt the another the accounting standard. Okay, so that means you calculate your cost by function. So here, so the different definition. So you have the cost of sales, selling, the general and administrative the expenses. So you don't need to list, okay, the personnel expenses, cost of materials, depreciation and amortization, and other operating income expenses. Okay, so key the profitability ratios. Okay, this one, 58.8. Okay, this one, how we get the gross profit margin. So here you can check. Hi, can sign. Yeah. Okay. Yeah. So paper. So I the so wait a minute. Yeah, can you check the one the paper? Okay. Yeah. Okay. All right. So this one. For 15.8.7. Well, 15.8.8. Okay, we check here. So 100 minus. Okay, 100 minus. Okay, minus this one. Okay, or this one. Which one? Minus one. If you adopt the accounting standard by function, so you need use the 100 minus 1.2. Okay, so you get a 58.8. Okay, yeah. So EBITDA, okay, so you minus this one. Okay, EBITDA, so you have a limit EBITDA, so you need minus this and this. Okay, you check. Okay, check that. All right, and on PAT, okay, so here, and net profit margin here 13.2 here cent. Okay, so any question? Okay, so we take a break. Okay. Okay, continue. Okay. Okay, so next, we doing decomposing asset turnover. So why we have to decompose it? So because we want to know more about the management to the assets. Yeah, and so it's as important as we know uh, the uh, the other ratios. Okay, like ROE, right? Okay, so here we doing so just the get more information and how the firm uh, manage its assets. Okay, so as in previous the slides we provide, the asset management is one of the four levels, right? Okay, so here so say that the asset management is the key indicator. Okay, so asset turnover must be broken into the primary components. Okay, so as so working capital is the difference between current assets and the current liability. Key ratio is for to analyzing the management of working capital, include operating working capital to sales, operating working capital turnover, accounts receivable turnover, inventory turnover, accounts payable turnover. Okay. Um, so the table 5.6 so show that different firm different year and its peers. Okay, uh, so the first row we see that at the 2014 year, the HMN is the operating working capital over revenue, so 10.8. Okay, so the here PPNE. Okay, PPNE that is the property, plant, and equipment. Okay, so here's PPNE over revenue. That is the 59.9. Okay, so operating working capital turnover and the net non-current operating asset turnover and PPNE turnover, trade receivable turnover, debt receivables, inventories turnover, that's the inventories, trade payables turnover, that's the payables and cash conversion cycle. Okay, so borrowing allows the firm to asset to capital, but increases the risk of ownership for equity holders. Analysis leverage can be performed on both the current and the non-current debt. Liquidity analysis relates to evaluating current liabilities. Solvency analysis relates to the longer-term liabilities. Okay. So liquidity analysis, there are several ratios useful to evaluate firm's liquidity, including the current ratio, quick ratio, cash ratio, operating cash flow ratio. Each of these ratios attempts to measure the ability of firm to pay its current obligations. Knowing how the liquidity ratios are calculated allows the user to understand how to interpret them. So the definition, the ratios, uh, we have the current assets over the liabilities, less the definitely current ratio. Quick ratio, here we not include all in current assets. We just withdraw the cash and the marketable securities and trader receivables. Cash ratios we just withdraw, okay, from the current assets, okay. We only withdraw the cash and the marketable securities, okay. Operating cash flow ratios, we take it from the operations, okay. So here show that, okay, liquidity ratios, okay, in different year, 2014 and 2013, okay. Question. Okay. So this table. So whatever you use the some ratios to evaluate liquidity of firms, that's okay. So depending on your experience, okay. So you compare it to the another one in firms, okay. So like you can take the current ratio of the HMM at 2014, compare it to the other peers, okay, and or it's a competitive opponent, okay. So this column, okay, check this, okay. So current ratio is a little bit larger than the index and other peers, okay. But for the quick ratio is not a little bit larger than the index, okay. So like it's smaller than the index, okay. Yeah. So this one, so you can take one to be your main index in liquidity analysis. Okay. Okay. So here, debt and the coverage ratios. Beyond the short-term survivals, solvency measures the ability of firms to meet the long-term obligations. Several useful ratios are used to analyze solvency. For example, the liabilities to equity ratio, okay, total liabilities over shareholders' equity, and debt to equity ratios, current debt plus non-current debt, and the debt to capital ratio. The current debt plus non-current debt. Okay, so which one you like, that's okay. So you can take this one to be your debt ratio. You can also take this one, debt to equity ratio, to be your uh, ratio to analyze the solvency, okay. That's okay. So two ratios specifically address the ability to pay the interest on debt. First one, interest coverage. This is earning base. Okay, so this is a numerator including the profit or loss plus interest expenses plus tax expenses, and the next one, the cash flow basis interest coverage ratio. So we have it in the cash flow from operations and plus interest expenses plus tax paid. Okay. So the different obvious difference in their numerators. Okay. Okay, so here table 5.8 debt and the coverage ratios. Okay, so provide the ratios in different years. Okay, so you can see that liability to equity, debt to equity, debt to capital, interest coverage, earning base, interest coverage, cash flow base. Okay, so you can compare that in different year and the same year. Okay. So comprehensive measure referral ratio is the sustainable growth rate, which use the RE. So sustainable growth rate, we want to get from the RE times the 1 minus the dividend pay ratio. Okay, so dividend pay ratio is defined by the cash dividends paid over the profit or loss. Sustainable growth rate measures the ability of firm to maintain its profitability and financial policies. Its components may be seen in figure 5.2. Sustainable growth rate and the dividend payout. So we have to continually support the investment. Okay, and the effective investment, like firm have more earnings and more competitive. Okay, so so more competitive and more earnings can be measured by operating ROA and the financial leverage effect. Okay, operating ROA can be measured by the net operating profit and operating assets. Okay, so the financial leverage effects can be measured by the spread and the net financial leverage. Okay, financial leverage include a debt over equity, cash and the marketable securities over equity, or the interest coverage, earning base, cash base. The spreads are net effective, the interest rate. Okay, interest income over cash and marketable securities, expenses over total debt, operating working capital turnover, operating non-current asset turnover, receivables turnover, inventory turnover, payable turnover. The gross profit margin, SG&A sales, NRD sales, effective tax rate, operating profits. Okay, so ROE 14.1.3, 13.8.5, and 25.4, 26.8. Okay, so here it's ROE is a subscript. So how to you can want 41.3 equal to 1 minus 78.7 time the multiply the 41.3 by the 1 minus 78.7, so you get the sustainable growth rate 8.8. Okay, so next, the ratio analysis. Previously discussed used the accrued accounting. Cash flow analysis can provide further insight into operating, investing, and the financing activities. Our companies use IFIs are required to include a statement of cash flows in their financial statement. Analyzing cash flow information, a number of questions can be answered through the analysis of the statement of cash flows. Example, operating activities, investing activities, financing activities. How strong is the firm's internal cash flow generation? How well is the working capital being managed? How much cash did the company invest in gross assets? What type of external financing does the company rely on? Did the company use internally generated funds for investment? Did the company use the internally generated fund to pay the dividends? In cash flow analysis, we provide a difference in reporting cash flow information, allow for variation across firms that complicates comparisons. An analyst can make the adjustment to net income to arrive at the free cash flows. A company uses a metric for financial analysis. Table 5.11. Okay, so here, profit before interest and tax, minus tax paid plus the T-shirt interest paid. Okay, so we have the non-current operating accruals, and we have the operating cash flow before working capital investment. Next, a liquidation of operating working capital, operating cash flow before investment in non-current assets. Okay, so interest received, dividend received, and net liquidation of operating or investment non-current assets. So the free cash flow available to debt and equity. So here 2089.5. So after tax, interest paid 920, net debt or issuance 14,279. Free cash flow available to equity. So you have the 1544.8. So dividends payments 15,723. So we let minus 275. Okay, so here compared to your previous year, so 252. So this year more. Okay, more negative cash flow. Okay. So concluding comments. There are two primary tools in financial analysis: ratio analysis and cash flow analysis. Analysis is to assess how various like term items in financial statement relate to each other and to measure relative the performance. The cash flow analysis to evaluate liquidity and management of operating, investing, and the financing activities as they relate to cash flow. Both forms analysis must be evaluated where considering whether firm performance is consistent with the strategic initiatives of management. Okay, this is our chapter 5. So any question? So no question. So we continue to introduce the chapter 6. Okay, so chapter 6 is based on the chapter 2, chapter 3, chapter 4, chapter 5. We do the for prospective the analysis, and we give the properly forecasting number. Okay, so in chapter 6, we provided some of the key concepts. First one, the strategy, accounting, financing, financial performance analysis provide the valuable information that help to shape the forecast assumptions. Forecast of future performance should be comprehensive, including all the condensed financials in statements. The starting point forecast should be the time series behavior of key measures such as revenue growth, earnings, and ROE. So typically, a few key strategic drivers are critical to forecasting future firm performance. For example, a breakthrough technologies, business analysis, and the business line expansions. The practical approach begins with deriving condensed financial statement. They contain key elements of income statement, balance sheets, and statement of cash flows. Typically, estimating future revenues is the critical first step in arriving at forecasted financial statement information. Past performance may be used to understand the behavior of the key measures such as the revenue of earnings. Starting the time series of measures such as earnings can provide insight to trends of future performance. Measures from the prior periods provide benchmark to compare forecasts against. Okay, so the table, the figure 6.1, a behavior-driven revenue growth for European firms over time, 1995 to 2014. Okay, so this one, the revenue growth. Okay, so this one, so over time, so converge to the flat line. Okay, this one. Okay, so on every earning follow a random walk or random walk with drift. Long-term trends tend to be sustained on average. Return on equity behavior is dependent on both earnings and asset base. Patterns tend to be mean reverting. Okay, this one mean reverting. Okay, so how it can be decomposed automatically to the following components. Okay, so as we mentioned that before, an operating margin times the operating asset turnover, or return on investment assets, or spread return on the business asset minus interest after tax, or financial leverage. Analyzing the behavior of the components from the 1995 to 2014 provided the following insights. Operating asset turnover and the financial leverage tend to be rather stable. NOP margin is the most variable component ROE and drive changes in the spread. Okay, so how forecasting relate to other analyses? Accounting analysis and the financial analysis help to understand which factors draw the past performance. Forecasting can be seen as performing a reverse financial analysis. What are the expected future changes in performance drivers? How do such the expected changes translate into future changes in performance? Economy industry strategy, accounting. Okay, the past financial performance, the future financial performance, future economy industry. Okay. The steps of the forecasting process. Step 1, predict changes in environmental and the firm spec factors. Okay, use the HMM as an example. So from the macroeconomy analysis, how will the economy situation HMM geography segment develop? From industry and business strategy analysis, will a recovery of economy reduce price competition in the industry? How sustainable is HMN above the peer performance? Is it expected that new retailers will enter the industry? Will the HMN brand recognition help the firm to preserve customer loyalty? How will the average labor cost in production industries develop? How long will HMN maintain its policy outsourcing or production? Will HMN be able to successfully replicate its strategy in emerging markets? From accounting analysis, are there any aspects HMN's accounting that suggest past earnings and assets are misstated, or expenses or liability are being misstated? If so, what are the implications for the future accounting statements? Step 2, assess the relationship between the step 1 factors and the financial performance. HMM, what were the sources HMM are superior performance in 2013? Which economic factors caused the firm's profitability increase in 2014? Are these the factors and their performance effects permanent or transitory? Is there any discernible long-term pattern in HMN's past performance? If so, are there any reasons if the trend is likely to continue or change? Step 3, forecast the condensed financial statements. Okay, so here are revenue growth and the macroeconomic factors. Impact changing the macroeconomic conditions on the apparel retail industry. The apparel retail industry is cyclical industry. Near-term impact recession. Long-term impact is sufficiently unpredictable to focus on the competitive position and the strategy. European Union here, okay, so you can see 2013, 2014, 2015, 2016, okay, it's the economy rates, okay, the changes over time. Yeah. So primary drivers HMN revenue growth are investment plans and growth in revenue per store. So here, okay, to 12.8, 12.1, 11.4, 11.0, 11.0. Okay, so it's a number of stores added during the year. So the 2013, 356, 2014, the number of store added increased to 979. Okay, 2015 increased to the 400. Okay, so 16,817. So increase. Okay, increasingly. Okay. So this one. So the primary drivers at HMN's revenue per store are currency exchange rate change, and changes in-store portfolio composition, and changes in consumer demand and the inventory markdowns. The NPAT margin, economy factors that contribute to changes in HMMBOT's margin, input price, foreign currency, inventory markdowns, SG&A cost stickers, ETR changes, and the net effects of new investment, product offerings, and online activities. Other measure for HMM, working capital revenue, likely refer to lower levels because of continued improvement in inventory turnover, non-current asset to revenue. Capital structure has been stable in the past. We are likely to remain stable in the future. Make the forecast. Though HMM exhibits superior performance in the short run, mean reverting behavior is better in the long run. Okay, so financial statement, HMM. Okay, we predict that. Okay, after 10 years, so from the 2015 to the 2024. Okay, so the business assets. Okay, at 2015, we predict the 112.4, 70.072, and last year we predict 248 at 80, and the previous loss at our next the predict 23. 114. Last year we predict 24,109. Okay, so our ROE the in the new coming year 40.8, and the last year 23.2. Okay, so deep changing over time, yeah, year by year. So next we introduce the sensitivity analysis. Forecast should be done with the more than one possible set of assumptions in mind. In HMM's case, there are at least two likely automated situations to those used for forecasting financial statements. Upside case, the projected effects competition turned out to be too pessimistic, resulting in a smaller decline in NPAT margins. Downside case, projected increase in HMM store productivity turns out to be too optimistic, threatening the company's revenue growth. Concluding comments, forecasting is the first step in prospective analysis of firm performance. Preliminary business strategy, accounting, and the financial analysis should form the basis for many assumptions used in forecasting. Forecasts should be comprehensive and include the key elements of financial statement. When forecasting, the time series of behavior of the various statistics should be kept in mind. Okay, this is our introduction chapter 6. Any question? Any question? So no question, we take a break.